Here to talk about things, we have Scott Gecas with us. He's live from the trading floor in Chicago. He's with Walsh Trading. And we noticed, and it was pretty obvious on the wheat trade, where the July contracts were going one direction and the other months were going the other. And I guess that's truly indicative that today is options expiration on that July contract, right?
Yeah, it's pretty much the options are expiring, the future contracts are expiring. Why that's important is because it's going to cause a lot of the funds, a lot of the position traders to either roll their positions, get out of their positions. When you're looking at the expirations, something like this, it tends to have a dramatic increase in volume towards the end of the day, right around the close. They don't want to be either assigned or exercise the options, so that's where you're going to see a dramatic increase, typically, not always, just typically close to within the last 20 minutes of the trading day. You're going to see a big explosive amount of volume on a typical basis. We're going to see if that's going to hold true this time, but only time is going to tell.
So you might explain again to our viewers on the options. Not everybody's familiar with how they work. It's almost like an insurance policy, but if you buy an option, whether it's a put or a call, it can expire worthless, right? But if you actually are the seller of that option, you could have somebody, as you mentioned, exercise that on you, and then you would have to take a futures position. Is that right?
Yeah, that is correct. And that's why being short options has a lot of unlimited risk. If you're going to sell the option, you're trying to sell the option, collect the premium that you sold the option for. But if it gets exercised, then you have the obligation to deliver that futures contract or that physical commodity at that price by that certain date. So that's why you're going to see a lot of position movement around towards the end of the day, because, average people, unless if you have that large farm, they don't want to get stuck with, 50,000 bushels of corn dropped on somebody's driveway. So that's where you're going to run into a lot of different types of movement towards the end of the day.
Interesting stuff. There's a lot of work right now, and thanks for explaining all that. Very important stuff, and I appreciate that. We'll come back in a moment and talk more with Scott about our livestock trade. All kinds of stuff going on there. You don't want to miss it. We'll be right back. We're back to talk with Scott Gecas of Walsh Trading in Chicago, and he rejoins us right now from the edge of the trading floor. All kinds of pressure in the livestock complex today, Scott, as we head toward the weekend. How much talk are you hearing among the traders about the upcoming cattle on feed report?
Well, the cattle on feed report is going to be a significant factor. It's going to be all going into the placements. The placements are expected to be off by 4.2%, which is going to be outside of the range. So we're going to have to see where that number actually comes out. But, the seasonal demand just hasn't been showing up. The weather has a dramatic factor in all of this. The weights are down. Prices are lower. You've seen the cash cattle trade anywhere between 108 to 110. That's significant. It's just more and more, as time goes on, you're seeing more and more bearish tone to it. So we're going to see how this is really going to play out.
So it seems kind of odd in a way that you have the Dow Jones Industrial Average, I believe, made new historic highs today, right? It's still like 52 points higher. The dollar value is lower. That would make our goods cheaper versus foreign competitors. And it just seems like things are kind of lined up that would be supportive of the market, and yet it's kind of falling apart anyway. How important is it that we hold those contract lows here on the cattle? Because I know we're really close.
Yeah, we're really close to those contract lows, and we have to hold those to get any type of upside movement. Now, when you're talking about correlations between the stock market and the protein complex, you also have to remember that, just about 3 weeks ago, going into the FOMC, we were expected either unchanged or a 0.25% hike. Then they said unchanged. With the expectation, they priced in about 100% chance that they're going to cut rates by a quarter in July. Yesterday, there was rumors of a 50 basis point cut. That is the reason why you're seeing gold jump. But if the government and they're expecting a slowdown with these rate cuts, that could be an additional downside for the protein complex as well. So you got to read between the lines a little bit. It's not just if the stocks go up, cattle should go up, or protein complex should go up either.
All right, let's look at our live cattle trade then right now. And on the big board there behind you, and the trading pits, we currently have the June live cattle down 77. August is down 80 at 103.15. That's likely where most of the volume is centered today, but it's still $1.10 off its earlier low today. On the feeder cattle trade, right now you have that August contract trading unchanged at 134.70. So look at that comeback. That's $2 and almost 30 cents off its earlier low this morning. September just 47 lower now at 134.90. And on the lean hogs, the lean hogs have been hitting limit down time and again, but we have August now limit down $3 lower at 77.90. October is back to trading again. It's down 282 at 72.90. Thanks, Scott, for talking with us. Scott Gecas of Walsh Trading in Chicago, and that is your latest information on the market, sir. Christina.